Imagine two people. One spends years building a massive savings account. Every extra dollar goes straight into the bank. No risks, no debt, no investing, just saving. The other person does something that sounds much more dangerous. He buys investments, puts money into index funds, and even takes on a mortgage to buy a house. If you asked most people which one is making smarter financial decisions, they'd probably choose the saver. After all, saving money is responsible, right? But 30 years from now, one of these people could end up with several times more wealth than the other. And the reason has almost nothing to do with intelligence, income, or luck. It comes down to understanding one invisible force that's affecting your money every single day, whether you realize it or not. My name is Alex, and if you want to build real wealth instead of accidentally working against yourself, you're in the right place. Because today, we're talking about the silent wealth killer that almost nobody pays attention to until it's too late. And that force is inflation. Now, before your eyes glaze over and you think this is going to be some boring economics lecture, stick with me. Because inflation isn't just something economists talk about on television. It's the reason your grandparents bought houses for prices that seem completely ridiculous today. It's the reason a fast food meal costs twice what it did a few years ago. And it's the reason keeping all your money in a savings account can slowly make you poorer, even when your account balance keeps growing. Let me show you what I mean. Imagine you have $50,000 sitting in a savings account. Every time you log into your banking app, the number is still there. Maybe it's even a little higher than before because you're earning some interest. That feels good. It feels safe. It feels responsible. But here's the problem. The number isn't what matters. What matters is what that number can buy. And that's where most people get trapped. Let's say inflation averages just 3% per year. That doesn't sound scary. 3% sounds tiny. But over time, small percentages become massive changes. If everything around you gets 3% more expensive every year, then your money has to grow faster than 3% just to stay even. Otherwise, you're losing ground. Think about it like standing on a treadmill that's slowly moving backward. You might feel like you're standing still, but if you're not moving forward faster than the treadmill, you're actually going backward. That's exactly what happens when your savings grow slower than inflation. The balance looks bigger. Your purchasing power gets smaller. And this is where people unknowingly make one of the biggest financial mistakes of their lives. They confuse safety with progress. Those are not the same thing. Keeping cash for emergencies is smart. Keeping years and years of wealth in cash is something entirely different, because inflation doesn't care how hard you work to earn that money. It quietly chips away at its value every single year. Now, let's look at someone who understands this. Instead of keeping every dollar in cash, they buy productive assets. Things like index funds, businesses, real estate, assets that tend to grow alongside the economy. At first, this feels much riskier. The stock market goes up, then it goes down. Some years are amazing. Some years are terrible. And emotionally, that's hard. Most people would rather see a stable number than a fluctuating one, which means their value often rises as well. In other words, inflation that hurts savers can actually help investors. That's a huge shift in perspective, because suddenly you're not fighting inflation, you're riding alongside it. Let's make this even more practical. Imagine two friends, both start with $50,000. One keeps it in cash, the other invests it in a broad market index fund. Fast forward 20 years. The saver still has roughly the same purchasing power problem they've always had. Maybe the balance grew a little, but inflation spent 2 decades taking bites out of its value. Meanwhile, the investor experienced crashes, corrections, and scary headlines. But over long periods, the market historically trends upward because businesses continue creating value. The result? The gap between the two people becomes enormous. Not because one worked harder, not because one was smarter, because one owned assets and the other owned dollars. And here's the really interesting part. Most people don't notice this happening. Nobody gets a notification saying, "Congratulations, your money just lost 3% of its purchasing power." It happens quietly, slowly, year after year, which makes it incredibly easy to ignore. Until suddenly, Things you plan to buy feel impossibly expensive. Maybe it's a house. Maybe it's retirement. Maybe it's simply maintaining the lifestyle you expected. The finish line keeps moving. And if your money isn't growing faster than inflation, you're chasing a target that keeps getting farther away. Now, let's talk about debt for a second, because this is where things get really counterintuitive. Most people think all debt is bad. And to be fair, a lot of debt is bad. Credit card debt, high interest consumer loans, financing things you can't afford, those are wealth destroyers. But not all debt works the same way. Imagine you take out a fixed rate mortgage. Your payment stays roughly the same for decades. Meanwhile, inflation keeps making everything else more expensive. Your groceries cost more. Your salary increases over time. Rent prices rise. But your mortgage payment stays fixed. That means every year, that payment becomes easier to make. Inflation is actually reducing the real burden of that debt. The house may increase in value. The payment stays the same, and over time, the economics start working in your favor. That's why many wealthy people don't avoid all debt. They avoid bad debt. There's a huge difference. One funds consumption, the other funds ownership. And ownership is where wealth comes from. But before you run out and start borrowing money, there's an important reality check. Assets are not magic. Stocks can crash, real estate can decline, investments can underperform. There are no guarantees. The goal isn't to eliminate risk. The goal is to choose risks that have historically rewarded patience. Because here's the truth. Keeping every dollar in cash isn't risk-free. It only feels risk-free. The risk is just hidden. When people see their investments drop 20%, they panic because the loss is visible. When inflation quietly steals purchasing power over 10 years, nobody notices because the loss is invisible. But invisible doesn't mean harmless. In fact, it can be even more dangerous because people don't protect themselves from threats they can't see. This is why wealthy people often think differently about money. They don't ask, how can I avoid risk? They ask, which risks are worth taking? Holding cash has risks. Investing has risks. Owning real estate has risks. Doing nothing has risks. The question is, which path gives you the best chance of building wealth over the long run? Most people spend their entire lives focused on the number, the balance, the salary, the amount. Very few people stop and ask a more important question. What is that money actually worth? Because wealth isn't measured by how many dollars you have. It's measured by what those dollars can do for you. And if there's one lesson I want you to take away from this video, it's this. Money is like an ice cube. Leave it sitting there and it slowly melts. The only way to protect it is to exchange it for something that grows faster than it melts. Once you understand that, you'll never look at saving, investing, or wealth building the same way again.